So in this video, we're going to talk about how we select options to trade instead of the stock. And if you know about options, great. If you don't, you need to go to Options Industry Council or the Chicago Board of Options Exchange and watch some of their options primers. Essentially, options are derivatives, which means they derive their value from the stock. And so let's just take a look at the chart that we have on the screen here. And this is a chart of a company called Ambarella. They make the little cameras and the chips that go in the GoPro cameras. So they're kind of a proxy for GoPro. And you can see this is a wonderful looking chart here on the left side, the weekly chart. And you'll see it goes up, consolidates, has another breakout, goes up, consolidates, has another breakout. And so we're in basically the third run of this breakout. And we believe that Ambarella is doing some great things. Fundamentally, they look good. They're making money. They've got great earnings. But technically, we saw this as a breakout. We've been trading Ambarella the better part of this year, and we recommended to our Market Club subscribers in October that we go ahead and establish a position. And this is a pattern that we call a genius bounce. So it went below this moving average, and then it saved itself, and it came up on good volume the next week. So during that week, we recognized that, and we picked up not the Ambarella stock, but we picked up the option. And so we like the chart, so therefore we look at the weekly, then we go over here, we look at the daily, and you can see this, it had a correction, which is on the weekly chart. You can see that correction here. It's represented by these red bars here on the daily. So many bars actually make up the daily, 5 bars generally. And then we saw it bouncing through this support level, this 50-day moving average here, this red line. And when we saw that healthy bounce, look at the volume on that. See that volume spike there? We believe that that was telling us that the institutions were going to defend that stock. And so that's what we looked at. And we recommended to our clients, you could either buy the Ambarella stock, which at that time was about, $34, $35, $38, let's say, if we look at this chart here. And when the stock was at $38, the options were trading much cheaper. So let me show you what we did. We went to the options chart and we bought the Ambarella November 42 calls. That means that they expire in the third Friday of November, or the third Saturday officially, but the last trading day of the third week of November, so the third Friday. They are for the 42 strike price, which means that at 42 they have value, and we paid a certain premium, and I'll show you that premium in just a second. So let's take a look at how we derive that premium. We'll take a look at what they call option chains. And here's what an option chain is. It's basically a chain of options that are derived from the value of the underlying stock. So we put in Ambarella, and you can see right here, let's move this into the center here, you'll see right here are all the different strike prices and option dates that are available. So here we have November 14th, weekly options, then we have the 22nd, which is the monthly options, those third Friday expiration options. And then quarterly are the ones that expire on the last Friday of the month. And so those are called quarterly. So you can see the different ones, weekly, monthly, and quarterlies all the way down. Well, we happen to choose the November 42, the November 22nd, the monthlies at 42. So here's what you do. These are all the options, and you can see this is the strike price, and just divide the screen into two, the left half and the right half. The left half are calls, which is bullish, and that's when you think a stock is going to go up, and the right half are puts, and that's when you think a stock is going to go down. Let's forget about the puts for right now and look at the calls. So we're going to go down and we're going to find the Ambarella 42 calls. And there you see the Ambarella 42 calls, which means they have value above $42. It means you get the option to buy somebody's stock at $42 if you buy this option. Obviously, we want it to go higher than 42, because if you can buy it at 42 and turn around and sell it at 50, well, then that's an $8 profit less what you paid for the option. Well, right now you're seeing the option sells for $560 to $660, but we were trading the option at a lower price. We bought it when, if you remember, Ambarella was trading at $39. Today, Ambarella is trading at $47 or $48, so it's up $10. Let's see what that did to our option. So we're going to eliminate that, and now let's take a look. This is the option. This is the stock price, right? You see the stock price moving up, and you could have bought that stock at $38 in this area here where we bought, right? This is the time we bought. It was roughly around that $38 level. But we wanted to use some leverage and eliminate or limit our risk. So instead of buying 1,000 shares at $1,000, right? What we did was we looked at the options. You'll see the option has kind of a parallel value compared to the stock. You see this, the dates are roughly lined up. You can see it declined quite a bit. These are the calls here. And then they bottomed out and then they increased up. So when we bought that stock, which is somewhere right in here on the 21st well, actually you can see when we bought it. It has the little tick marks on my TradeStation chart. You can see when we bought that stock. So when we bought that stock, we started, or the options, we started to buy them in this area. And as they continued to go up, you can see the stock continued to go up and it brought the options with it. So today we're up $14,500 on those options. And so we bought them in this price range, which looks like an average price of around, let's say 210 when you average it all out, because we bought it several times based on our criteria. And as we continue to add that to that position, we were able to manifest some gains. And so you can see that gain continues to go up today. So it went from $2 and say 70 cents all the way up to around $8. Well, if you only invested a few $1,000 in this, you had an incredible percentage return. From 2 to 8 is almost a triple. For 2 to 8 is almost a quadruple, actually, I should say. And certainly a triple to where it is today, because it's pulled back a little bit and we still have the options. They do expire a week from today, next Friday. So this was the experience that we got. We made $14,500 and we didn't invest a heck of a lot in those options. We invested just a few $1,000s. Instead of putting $38,000, we were able to get a higher percentage return by using the options. And essentially, if you believe in the stock is going to go up and the options have a good value, in other words, they're not overhyped and they're too expensive, then you should buy them. If something's overhyped and in the news and expensive, they have high volatility. And since options gain their value from volatility, they might be a little bit more expensive than you should want to pay. And then either you could buy the stock or you can sell the options. And that's an option. That's a subject for another video. But that's how we analyze options and go through the motions of putting it all together. And instead of buying the stock, we buy the option. Hope that helps you.